All right, guys, I hope you're doing well. James here from jamesdforsythe.com. And so, going over a recent speech given by Michael S. Barr, right? Basically about the promises and risks of financial innovation, as we'll put it, right? And so, this very obviously kind of goes into crypto, especially in given the financial innovations we've been dealing with the past few years. And he gives some pretty good examples, I think, and also just really reiterates the points that we've seen from other Fed governors about the topic as well. So, with that being said, we'll head to the screen share. And yeah, there we go. So, financial innovation has always brought promise and risk, and the urgent need to get regulation right. And so, in 1610, when Dutch merchants and bankers were otherwise busy creating global finance, a series of destabilizing bank runs also moved them to establish a ban on short selling. Many of the issues we grapple with today are not as new as we think. And so it's pretty interesting that he gives this example going all the way back to 1610, because I remember something similar happening in, I believe it was the late 1800s. Remember it vaguely. I just kind of pretty much just read it in a book I've been reading about the House of Morgan and that sort of thing. So, but this isn't anything particularly new. And I think it was also specifically with banning short selling in a way. I forget if it was like a government imposed one or kind of more of a private, like brokerage wide thing or whatever it happened to be off the top of my head. But regardless, basically going on this whole, at least they kind of look at both sides of the coin, so to speak, by looking at risks and promises. Excuse me. So it's like at least they kind of do somewhat of a cost benefit analysis. Now, granted, you might not agree with it, or maybe you do, but it's still at least they're doing it, right? And so the promise of fintech is that it can make financial products and services better, faster, cheaper, and more available. So financial innovation supported by new technologies can disrupt traditional providers by spurring competition, creating products that better meet customer needs, and extending the reach of financial services and products to those typically underserved, right? So kind of the whole purpose of fintech in general, which again is one of the promises. And then we have seen through history that excitement over innovative financial products can lead to a pace of adoption that overwhelms our ability to assess and manage underlying vulnerabilities, right? And so basically the whole crypto bubble we have dealt with, if I could speak this morning, um, the past couple years, right? It's kind of I think it's fair to say it was a bit of a mania, at least from what I've noticed from studying like previous financial panics and such. I mean, when you're naming NFL stadiums and that sort of thing after with crypto related, was it a company or a coin itself? I don't remember. But either way, you kind of, it's kind of a sign. And so, to continue, as we saw in the lead up of the GFC, innovative financial products can mask emerging risks, resulting in significant harms to businesses and households and ultimately undermining financial stability. So, these products can leave consumers vulnerable if they are not coupled with meaningful disclosures and basic protections against abusive practices, right? And so, one of the things that I think is worth pointing out and not really placing or a connotation or anything from what he just said, but I notice a lot of people when they deal with this kind of, it's like when you have some new innovative technology, right? And so it kind of gets a little bit overextended as how I like to think about it. Meaning like especially in terms of the regulations is what basically we're so focused on the innovative part and then in doing new things that they kind of it hasn't been around. Hasn't been around long enough. It hasn't been tested enough, so to speak. That there's these little kind of holes in it that you don't realize. And it's not that they aren't looking for them; is that They just haven't had it long enough to be able to find it. And you're not exactly looking for something specific until it kind of pops up. It's stuff like that happens all the time. It's kind of like a characteristic of trying something new in general. It's like you're going to find little kind of nuances in the process, the product, whatever it happens to be that just didn't work out as it would, or it basically you just weren't expecting that to happen. And so it's not necessarily placing a value judgment or malignant intent on the innovators. Is just kind of by nature of innovation. That's just something that happens. Is you're going to have these um, failures in a way to where they weren't expected, and kind of keeping that in mind. And not saying that's a bad thing at all, because that's what's going to happen regardless if you try to do anything new, right? It's just that because they're financial innovations, they happen to leave, as he says, consumers vulnerable, especially if these quote unquote meaningful disclosures and basic protections aren't kind of disclosed, right? Because maybe they don't know of them yet, or they just haven't gotten there, sort of thing. And it's not until something breaks in a certain way that you realize that it can break that way, right? Trial and error, so to speak. And so when regulations are too prescriptive or regulators too cautious, they run the risk of stifling innovation and locking in the market power of dominant participants in ways that can raise costs and limit access. So when regulation is lax or behind the curve, it can facilitate risk taking and a race to the bottom that puts consumers, businesses, and the economy in danger and discredits new products and services with consumers and investors. Right. So this is where it's kind of getting into, the balance between the two, between the risks and the promises, and like how are we exactly can we regulate such a thing to where we're not stifling it so we don't have that innovation anymore, or but we're also not too lax to where it can just run free and basically like a bull in a china shop just trample anything and everything, right? So crypto assets, getting explicit now, have grown rapidly in the last several years, both in market cap and in reach. But recent fissures in these markets have shown that some crypto assets are rife with risks, including fraud, theft, manipulation, and even exposure to money laundering activities. And there's always going to be bad actors in something, right? I think that people tend to focus too much on, like I said earlier, the malignant kind of players, um, who do have bad intentions, so to speak, of these new technologies and stuff. But it's also like you're going to have the opposite as well. And it's just kind of striking a balance between the two. And I also, this stuff happens all the time in the US dollar too. So I hate how some people basically will just say, like, oh, it's because it's crypto. You know how much money is there in US dollars like every year? Like, it's nothing new. It's just kind of something that, like, there's always going to be, I guess, kind of underground things in that respect. It's like you're not exactly going to stop it, so to speak. Um, it's like if someone really, really wants to do something, they're probably going to do it regardless of what laws are in place, right? There's always going to be somebody who wants to do something so bad that um, the risks of doing so are going to be worth it for them, right? Because it's still a risk reward analysis for each individual person on whatever action they're planning on doing. And so they're basically just going to, if the reward to them, I guess perceived, if the perceived reward for that individual is greater than the perceived risk, they're probably going to do it anyway, right? I say perceived for a reason because there is that obviously subjective opinion of the specific person, right? So, just to go on, kind of going a little bit on the some work that the Fed, the Board of Governors specifically, has been doing with the Office of the Comptroller of the Currency and the FDIC. Basically, in August, they issued a supervisory guidance that outlines the steps the Federal Reserve supervised banks should take prior to engaging in crypto related assets. And it's a link to a website, and I'll do a separate video on that because I thought it was pretty interesting. to go into that more in depth. So that'll be here in the future. And also, just I put the links to these things in the description for a reason, so you guys can go and read them yourselves, because that's highly recommended. I think something you should do your own research, sort of thing, get your own opinion. I kind of just put it out there and think out loud for a bit. But so that'll be there as well. So, and part of the reason why they want to regulate this so much, specifically with regards to banks. And so his argument is, when a bank's deposits are concentrated in deposits from the crypto asset industry or from crypto asset companies, they are highly interconnected or share similar risk profiles. So banks may experience deposit fluctuations that are correlated and closely linked to broader developments in crypto asset markets. Right. And so it's kind of like, if your depositors start to go under, they kind of need their deposits back to cover whatever their mistake was, right? Or whatever happened to them, so to speak. And so basically, they can kind of inadvertently affect the banks that way. But again, considering kind of the scale of banking, unless you have a very, very large entity or crypto asset company in this respect, um, banking with a rather small bank, I don't really see how it would be that significant, especially since banks nowadays don't really need your deposits for anything. And that's kind of reflected in the interest rate you get on your deposits to begin with. So it's kind of, I don't know how much kind of weight to give such a statement on how much it's actually applicable. I mean, I see the logical like connection to it, but it's also like, in practice, I'm not sure exactly how much weight to put on that, I guess. So, in addition, misrepresentations regarding deposit insurance by crypto asset companies can cause customer confusion and lead to increased withdrawals at banks providing deposit services to crypto asset firms and their customers during times of stress. So, I don't remember specifically, but there was something with regards to a kind of a crypto asset company, so to say, that it's like you had to really look into the fine print to see that it was actually wrong. But if you just kind of superficially glanced over it, it was like it would lead some people to believe that they were covered by the FDIC, which they weren't, right? And that was, I think it was like, they were talking about, or in their disclosure or whatever for the crypto asset company, they said like their bank account and their assets or whatever are FDIC insured through their bank. But it wasn't necessarily like, if you put money into their company or whatever, that would be FDIC insured, right? And so there's kind of like a little nuanced thing to where it could cause this customer confusion. And again, I forgot the name of the company that did that. It was quite some time ago that I went over that. So to continue, we kind of go into stable coins, because he seems to be separating like the broader kind of crypto assets and then actual stable coins themselves. And that's because the stable coins are kind of similar to these, as he calls, money like assets, right? And since they're kind of purported to maintain this like stable value, this kind of is why he calls them money like. It's because of the stable value that they're supposed to represent. And so basically, he says history has shown that money like assets are subject to runs that can threaten financial stability. And then basically, the Fed is very interested in the stable coins that are linked to the dollar, because he basically says that stable coins borrow the trust from the dollar because they're linked or pegged, so to speak, to the dollar itself. So that he says they have a binding interest in a strong federal prudential framework for their use for the stable coins that are linked to the US dollar, right? Since they kind of piggyback on the trust of the US dollar itself. And so the president's working group report on stablecoins that came out about a year ago called upon Congress to take the necessary action to ensure that stablecoins, particularly those that serve as a means of payment, are subject to prudential regulation, right? So kind of just continuing on that thought. And then this gets into something I'm not as familiar with. So we are seeing, just kind of quoting him directly, we are seeing banks explore a variety of different models to issue dollar denominated tokens on distributed ledger networks. And so the proposals range from issuance of tokens on private controlled networks to facilitate payments within or among banks to proposals that explore issuance of freely circulating tokens on open permissionless networks, right? So getting more into the crypto assety part of it, where you get into the more kind of nuanced stuff. And so, but my main point that I wanted to talk about is what I put in green. And so, for instance, with some models that are being explored, the bank may not be able to track who is holding its tokenized liability or whether its token is being used in risky or illegal activity. So while there is work underway on technical solutions for managing these risks, it remains an open question whether banks can engage in such arrangements in a manner consistent with safe and sound banking and in compliance with relevant law, right? And so it's mostly because, or it seems like it's mostly because the banks can't really track who's holding, as he says, tokenized liability. And so I guess it kind of comes with the KYC laws that they have to deal with. So like the know your customer stuff, basically saying it's like, they don't, and they can't track it, so to speak, in terms of like who has what at what time, what they're using it for, and that sort of thing, which is not something that's very, kind of gets a little bit more into the authoritarian side of banking. I don't know. That's not the best way to describe it, but that's kind of what comes to mind right now, right? And so it's just they can't track who's doing what, so to speak, with what and how much, and that's where they're having troubles with it. And this kind of parlays into consumer autonomy, right? And so basically goes into how the digitization of financial services basically has created a vast amount of customer data, so to speak, and then basically going into open banking in this respect, right? And so he gives an explicit example of, or not example, but like for the United States. So this has to do with the Consumer Financial Protection Bureau and how it says is charged with implementing regulations to give consumers access to their financial data, right? And so this reminds me a lot of I did a video quite a few months ago on basically these different kind of scores that individuals have. It's kind of like it's similar to a credit score, but it's not through the credit bureaus. And it's basically like you're not allowed to have access to it. And it's not necessarily just for lending. It's kind of more of like a modeling consumer behavior on a more nuanced scale. And I forget the name of it off the top of my head. I'll have to look for it and I'll put it as like an info card or whatever in the next few seconds. And so basically you guys can see that because I think it's very similar to how this is going. So basically concluding, how is the Fed doing and how is the Fed um, supporting this payments innovation, right? And how are they doing it for different financial products? So he goes a bit into Fed Now. I've done quite a few videos on that. Basically, instant payment system and so on. It solves a lot of the problems that have been proposed that a central bank digital currency would also kind of fix. But to say that Fed Now CBDC is just kind of a system and could be seen as kind of the infrastructure for said CBDC if one were eventually to come up. But again, that's not drawing them to be analogous, right? And so and this comes, he says this rather explicitly in the green paragraph. So, no conversation about payments innovation is complete without mention of CBDCs. So the Federal Reserve has not made any decisions about whether to issue a CBDC. And if we believe it makes sense to do so, we would want the support of Congress and the administration. Right. And so basically, then they're just continuing research and so on, looking at potential policy trade offs and other things as well. So basically, Fed now and maybe CBDC later. But then again, it's nothing to say that the Fed, is exactly wanting a CBDC, right? And I was actually quite surprised by coming, and I did a video only a few days ago about Governor Waller coming out and basically saying how the Fed should not have one, so to speak. And I'll put that one at the end of this video as well, so you guys can see that too. But definitely interesting dynamics, and at least they're looking at the kind of an actual cost benefit analysis of the financial innovation aspect of things with different products, and they're also giving kind of a controlled environment for it with respect to FedNow, to where basically the institutions that are going to be using FedNow or can be using FedNow um, can innovate with it and create products through it and that sort of thing. And so there's kind of there's guardrails to what they can do, so to speak. But yeah, so with that being said, stop the screen share, and I'm going to leave this one here. So with that being said, I hope you guys have a good night, and I will see you on the next one.